Hello friends and welcome to my channel Simply Stocks, and today I'm going to talk about Himadri Specialty Chemicals, one of the stocks for which a lot of requests have come in. Although I made a video in August September, here I am with another video, and let's understand whether the story is over and what you need to do. So let's get started. First of all, a disclaimer that this is not a stock recommendation, and people taking any position into any share that I talk about should do that with their own due diligence and research. And I am not in favor or against any company that I talk about. Before I start with analysis of Himadri Chemicals, here's a small request that kindly support me on Patreon, and once you do that, I'll make better videos on YouTube, and I'll help you in market companies queries, one-line answers on each. And once you take the $10 Patreon membership, you can view my portfolio, a watch list that I'm preparing, and ask small queries. Every day you can ask me queries through that $10 a month platform. For detailed market or company talk and for portfolio and everything else, you can email me and we can work something out. Also, you get access to exclusive articles or some news feed that I keep on putting on Patreon every probably alternate days or so. Now about Himadri Chemicals, it is the only fully integrated carbon chemical plant that they have. It established in 1990, and their different products like carbon black, coal tar pitch, corrosion protection, and specialty oils, etc. are the major products that they have. Usage in industries such as tires, defense, electronics, pipes, etc. Usage in lithium ion batteries as well, and this was the reason why Himadri Chemicals was extremely popular, that the usage of Himadri Chemicals products was in lithium ion batteries and in EV vehicles. So in electric vehicles where these batteries are being put to made, then we are looking at a very big business for the company. But it hit a roadblock over the last 2 years with the economic turmoil that India has been going through, and then with the kind of problems that we are facing at the moment with lockdowns and curfews, etc. If you look at the financials, then this is the December numbers of FY20 versus FY19, and look at the drop. So from 586 crore sales, it has dropped to 428. You can see a drop of something like 160 crores or something like 26-27% sales drop. Then you had a massive drop in profits from 81 crores last year, where it was flying as far as the stock is concerned when FY19 numbers were coming in, that is in 2018. And now we have a profit of only 16.7 crores. So you can see the difference. Operationally, the company has suffered, sales has dropped, and then the problem has been that the raw material cost has surged, and in the end what they ended up being with high debt, that the profit has reduced to probably smidgens, only 17 crores versus 81 crores. Decent promoter and institutional holding, I won't say very huge, but promoter holding of just about 50%, 47%. Good institutional holding, but still 20% free float. So it is not the likes of other companies where the free float is less than 10%, but still it is quite decent. Return on equity currently that it shows on Screener and on other websites, it is 20%, but I believe that ROE would have decreased and will decrease even further with the March numbers, etc. Operating profit margin at 18% will also decrease with the kind of problems that the company and the industry is facing at the moment. So, looking at the stock performance, it did exceptionally well in 2017, and we saw the stock peak at something like 197. It from 33 odd levels, 33 rupees. So that has been a massive upsurge of 6 times by the start of 2018, and that was the peak. Currently trades at 8 times earnings. It was trading at 18 times earnings a year ago, and in trouble with current health situation that we are looking at. So what has been happening is, with the kind of situation that we are facing at the moment, it looks like we are headed for more trouble for such companies into autos, auto ancillary, etc. Stock is down by around 70% from the peak of 100 and 90 200 levels, and I see that the recovery might take a longer period of time than just 1 or 2 quarters, and this will take at least a couple of years for the stock to stabilize. And once their high margin businesses such as the EV or the electric vehicle battery business for lithium ion etc really does well, until then the stock looks like could be in a range and could be depressed. Also, ASM issues have also marked the company. So you remember that about a year or year and a half ago, there have been many companies that have been put under ASM, and one of them has been Himadri Chemicals, and that has just continued. And this has also hurt major players to getting into such companies. So why the massive fall? So all autos are under stress. So if you look at it, the auto industry is completely under stress. Yes, we have seen a massive rally in the auto companies, in some of the auto ancillary, but these are only rallies that should be sold into. I believe that pure consumption plays will always do well, and the fall has taken place because if autos don't do well, then tires will not work, then EV push will not work, electric vehicles are not being manufactured that much because nothing is on the road. So EV push has been pushed back at the moment. So it's not quite there, and it's in the bag at the moment, and probably it will take a year or 2 years to really get it back into shape. Future demands for EVs, for vehicles, for tires, etc., look bleak as economy is currently shrinking. That is also a reason for the stock to remain depressed. So it fell, and it has fallen so much that afterwards now it doesn't look like that we will see a massive recovery in terms of numbers in the next 2 quarters. And when that is not possible, then why would somebody get into a very, you can say, a micro cap or a small cap company? So future demand looks very bleak as economy is shrinking, and economy needs to chug at around 6-7%. 6.5 to 7% is required for such small cap companies to really do well, because then they'll get their share of the meat, the share of the pie, and only then they'll perform at their optimum level. So I'm sure currently Himadri is not working at even 50% of their capacity. That's my assessment. I don't know officially, but with the kind of problems that they are facing, they had a direct play on defense with orders from DRDO as well. They might be delayed as well with the kind of situation that we are going through. So all these things combined is why the stock is at 45-46 rupees and not quite at even 100-120 rupees. Look for only direct consumption plays. That is my assessments and my viewpoint to you. So look for only buying into direct consumption, and in 4% economy, in an economic growth of 4%, only direct consumption leaders in the market would do well. So what needs to be done? I would avoid the company even at these levels unless I see some kind of future in the business, that the business is going to really move higher from here. I think the sales numbers will continue to be under pressure. If you have it, then keep a stop loss of 40, 36, 40 according to your risk appetite, and probably hold it for the next 3 to 5 years. This is a story that could be back to normalcy after 2.5 years and not immediately, because things have to normalize and economy needs to pick up. Better be in top brands, and I have been saying that time and again over the last 6 months that only top large brands will do well for the next 18 to 24 months, and they would go much higher than these small caps. Avoid these small caps at these levels and be ready for volatile moves if you're holding on to such stocks. So this was my video on Himadri Chemicals. Please like and subscribe my channel and hit the bell icon so that you can get my videos straight away when I post it. Thanks a lot for watching.